Our objective was to find an alternative mechanism to pick stocks that might have a better than average chance of earning returns that would beat the market. There are sell-side analysts who make a profession and a business out of doing analysis into companies' financial statements and evaluating their stock prices and making recommendations about which stocks they believe are underpriced and would be strong buys or buys, or stocks that seem roughly fairly priced, which they would then recommend to be holds, or stocks that they would deem to be overpriced, and then they would recommend that those stocks should be sold. So we collected a very large sample of analyst recommendations data. We had about 25,000 firm year observations over a roughly 12-year sample period. And out of those 25,000 or so observations, 73% were consensus buys or strong buys, and 25% were holds, and only 2% were sells. So there seems to be a real optimism bias in analysts' recommendations. Therefore, our objective was to turn to the financial statements and ask, is there a mechanism we can construct that will help us pick stocks and not have to rely on analysts' recommendations? So that was the question that we sought to answer. Our data challenges were numerous. It was an interesting data challenge. We merged data from 3 different sources. We pulled financial statement variables from S&P's CompuStat database. We pulled analysts' recommendations from the IBES database. IBES stands for the Institutional Brokers Estimation System. And we pulled stock return and stock price data from CRSP, the Center for Research in Securities Prices at the University of Chicago. We're lucky in this type of archival accounting research because there are large archival databases of accounting information, stock prices and returns and things like that available to us. The challenge is identifying the matches so that you're matching the correct accounting information with the correct analyst information with the correct stock price information for the same firms. And there are a number of firm identifiers that allow us to make sure that our matches are appropriate ones. And then we always do a fair bit of auditing and checking and cleansing of the data once we have the data set merged. Then once the data sets are merged, we still have to go through the sample selection process pretty carefully to make sure that we have available variables that we needed to compute all of those ratios. So it required quite a few accounting variables to measure each of these ratios. And so the data process took a while, but the challenges weren't too bad. So in our methodology, we identified 6 fundamental financial statement ratios. Ratios like, say, the gross profit margin relative to sales, or the rate of return on assets. Very basic, fundamental financial statement ratios like that. For each of these 6, we knew that on average, they tend to provide some information about the likelihood of a future increase or a decrease in earnings 1 year ahead. So for each of this, we computed these 6 ratios for each of our 25,000 or so firm year observations. And prior to our calculations, we specified ranges for those ratios. And the ranges were either very positive, indicating a high likelihood of a future earnings increase, or negative, indicating a low likelihood of a future earnings increase, or they were ambiguous. They were in the middle. So after computing the ratios, we then determined where each firm's ratios fell within those pre-specified ranges. And if the ratio fell into the very positive range, we assigned that firm 1 point for that ratio. If the ratio fell into the very poor range, we assigned it a -1 point. And if it was in the ambiguous range, we assigned it 0 points. And so then we summed the points for every firm for every year across these 6 ratios. And obviously the maximum score could be a 6, and the minimum score would be a -6. So if a firm had a predicted earnings increase score of 6, it meant all the ratios indicated a very good likelihood of a future earnings increase. And if the predicted earnings increase score was a -6, it meant all the ratios were in a very poor range and the firm had a very low likelihood of a future earnings increase. So then for our portfolio strategy, we took our predicted earnings increase scores, and for the top 20% each year, we formed a portfolio going long in those stocks and pre-committing to hold them for a full calendar year. We formed all of our portfolios on basically April 1st, and then would hold them effectively until the next March 31st. And for the bottom 20% of the firm years, the poorest predicted earnings increase scores, the lowest scores, we would again put those stocks into a portfolio that we would sell short on April 1st, and then settle up the short portfolio a year later on March 31st. And we did this, we rebalanced the portfolio every year for 12 years from 1993 through 2005. And we measured the returns that the stocks in our back-tested portfolios would have generated relative to the returns you'd have earned on average in the market each year. And so we tried to measure the market adjusted or the abnormal returns that you would have earned following our approach on the long side of the portfolio and on the short side of the portfolio. And then we measured the returns, of course, to a hedge portfolio. So if you hedged the long side with the short side, what would the hedge returns have been?